The main difference between SPLG and SPY lies in their database categories. SPLG falls under the large cap blend equities category, which includes ETFs that track a sector, category, or index, such as the S&P 500, and prioritizes diversification by investing in both growth and value stocks. In contrast, SPY falls under the large cap growth equities ETF category, focusing on growth company stocks with a market capitalization of at least $10 billion, with the goal of achieving returns that outperform the market. As a result, SPY promises better returns, while SPLG promises diversification. In terms of structure, SPY has a unit investment trust (UIT) structure, which pools funds from different investors to buy specific portfolios, and is typically managed by fund managers. This structure replicates the underlying index, and investors are beneficiaries under the trust. However, it is less flexible, making it ideal for investors who prioritize diversification. On the other hand, SPLG has an ETF structure, tracking an index but trading like a stock exchange, offering more flexibility and allowing for immediate reinvestment of dividends for potentially higher returns. However, this structure is subject to tracking errors, making it more suitable for hands-on investors. The expense ratios of the two ETFs differ, with SPY charging 0.09% and SPLG charging 0.03%. A higher expense ratio results in lower returns, so SPLG's lower ratio makes it more appealing to budget-conscious investors. Despite their differences, both ETFs share some similarities, including being offered by the same company, allowing for trading throughout the day, and having decent tax efficiency, as well as similar performance and yield. Ultimately, the choice between SPLG and SPY depends on individual investment goals. SPLG's ETF structure and blend equities investment style offer greater diversification, which can help weather economic storms. In contrast,